Welcome to the latest episode of the Quant Curl MoneyWise podcast. I'm George, your host, and I'm thrilled to speak today with Andrew Cain of GSI. As someone with a background in researching actively managed funds, today's discussion might seem like a slight departure from the norm. I first encountered GSI at the start of 2024 and was immediately intrigued by its focus on two global sustainable strategies. And when I recently spoke to Andrew, we had a fascinating conversation covering topics like sustainable fund labels, factor investing, and much, much more. So I'm absolutely delighted to continue that discussion today, as I believe that the listeners to this podcast will find this as insightful as I did when I first had that conversation. So welcome, Andrew. Thank you for joining us.
Thanks for having me, George. Nice to be here.
Can we just start with something just nice and easy, I suppose? Could you kind of give us a sort of brief overview of your background and career journey?
Yes, it started back in 94 on the investment side of my career. I joined Dimensional and stayed there for 20 years, starting in London in an investment role there, and then basically staying in investment roles all the way through my career at different levels. Moved over to Australia for 15 years, came back to the UK for another 4, left Dimensional and joined GSI shortly afterwards, where I've been for the past 10 years, actually just over 10 years now.
So can you kind of share the story behind GSI? And I'm guessing that you were behind the establishment of it, or you were there at the very early stages. So can you sort of, just get the story behind it, what inspired you to get involved and establish the business?
Yes, I wasn't there at the establishment. That was Garrett and Bernd. Garrett, who is also a former Dimensional colleague of mine, he had met Bernd at London Business School many years ago. And they got discussing various different investment ideas and so forth. And a lot of things resonated with one another. And they decided they published a paper together on factor investing, diversification risks, and so forth. And then made the decision to go out on their own and set up GSI. So they did a lot of work on that. I joined them a couple of years later. And that's when we set up the first UCITS fund. And it's taken off from there, really.
And I know that you've sort of talked about factor investing and how that drives returns. So it would be interesting to unpack that a little bit as to what it means, because, I guess for some people listening to it, they might sort of go, well, what is factor investing? Does it work? And what are the implications?
Okay, well, a huge body of research going back decades, looking at what drives returns in stock markets and elsewhere. But we're interested in stock markets, what drives returns and what you can use to build portfolios to determine future expected returns. And really, it's just a case of applying a scientific approach to investing. That is looking at the empirical evidence, making sure you have enough of it for it to be worthwhile, and then judging and analyzing that in a very methodical fashion, systematic fashion, to see whether there are any repetitive patterns, so to speak. Now, this has been done by lots of academics in various different guises. It's also been put into practice by a number of companies. And the term factors is just a useful name to give these things. So I'll give you an example. So take the size of a company. Smaller companies over time have outperformed larger companies, but it's over a long period of time. And recently that hasn't been the case, because the markets have been really driven by these big tech companies. Likewise, something like the ratio of a company's price relative to its fundamentals. That's a definition, or one definition, that's been used to distinguish value companies from growth companies. In other words, value companies have low prices relative to their fundamentals, and growth companies have high prices relative to their fundamentals. And over time, in various different markets, value companies have outperformed growth companies. Once again, not recently because of this whole the Magnificent Seven, the big tech companies driving returns over the past few months, actually a couple of years. And so these are the factors that contribute to a firm's or a portfolio's expected returns. Now, associated, I think, with a question that we discussed last time was, what about ESG, or environmental, social, and governance characteristics of companies? What happens when you incorporate those? To a rational person looking at that, you'd say, well, yes, if a company is doing the right thing, so to speak, you would expect that they would have. So, for example, let's look at it from the governance side, the G of the ESG. If a company has better governance structures within its firm and uses those for efficient running of the company relative to its competitors, you would think, well, it would have better returns. And the same arguments have been used for the environmental side and the social side. However, it turns out that there is no clear evidence over time that companies with better ESG credentials do better than their peers. Now, that there are people who argue that might be to do with poor definition of ESG or whatever. And I probably should qualify my statement by saying there has been no clear evidence yet, because there may in time become clearer evidence. But from our perspective, it doesn't. The environmental, social, and governance characteristics don't, to our mind at this stage, represent returns factors. They're not really the things driving a company's or a portfolio's returns. They're much more a special form of preference, I would say, an investor preference, that is. You might call it hygiene, if you will. It's, you want to have investments in companies that are not desperately bad polluters, that have good or better social credentials and look after their people, look after the environment, look after their society at large. So it's a special preference, but it's not something that we would use to determine the investment performance of our portfolios. We rely on the factors that have a great deal of academic background and support.
Yeah, I do want to kind of expand a little bit more on the whole ESG and sustainable side. But one thing I think that springs to mind, and it's something that I talked to you about before, and it's about this whole thing about index versus your strategy. And you kind of, you talk about this whole thing about factor investing, and the world appears to be quite polarized. So you've got this kind of, you either have to be active or passive. Sometimes there's kind of a blend. And I guess my initial approach when I listened to what you said previously when we first spoke was, this is kind of just an index strategy. It's an index approach. And I know that's something that you've kind of politely corrected me on. And I just think it would be something to really unpack, because I think the way that people are looking at investing is changing. And there is no longer this thing about passive or active or index and so forth. So it'd be really interesting to kind of get your sort of thoughts around that.
Well, to your question about us versus an index, for example, index investing, to my mind, is when you subcontract out your investment strategy. You basically hand the investment strategy to an external party, in this case, index providers. And they have various different ways of determining or defining their constituent companies and the weighting schema and so forth, which is actually very good for a very cheap, low-cost option. But that's not what we do. We will share many characteristics with index providers. Low turnover, for example, very highly diversified, so hundreds or if not thousands of names in a portfolio. There'll be reconstitutions of our portfolios over time, which of course the indexes do as well. And we start from a market cap weighted basis. And what I mean by that is the size of the company determines the amount of money that you put into it. So larger companies tend to attract larger amounts of money or investments. They have a greater weight in the portfolio. And an index, that's almost like their pure approach. We deviate from that because we have these factors that we apply. So we move away from market cap weighting where we want, so for example, if we want to shift the portfolio towards smaller companies, we'll end up underweighting the mega caps and overweighting the medium small caps. And if we want to invest, when we want to invest or increase the exposure of the portfolio to value companies, we do the same. We move away from market cap weighting, increasing the exposure to or the weight in higher value companies and decreasing in the more growthy companies. So you can see that there are characteristics that we share with indices or indexes, but we are very, very different, and we have a much different returns profile to them.
And in terms of, I guess where someone listening to this is, like if you take an index strategy as an example, and let's say a global one, because your funds are global, then I'll take on that. If you look at global and you look at their top 10, they will literally just go Nvidia, whoever it is, Meta, etc.
Yeah.
How do you pick those constituents within that? Because I think that's probably the right way of looking at it. It's more about how do you say, okay, if I'm going to go overweight large cap, then how do I pick that group?
Right. Okay. So, our process is relatively involved, and there are lots of moving parts. But essentially what happens is we start from an index basis. We say these are all the stocks that we could invest in. And the basic starting point is market cap weight for all of these stocks, because that's the lowest cost, lowest turnover, and most, let's call it, stable investment starting point. And then you go, what do you want to accomplish? Our goals here are to achieve long-term total returns in excess of just a plain market cap weighted index. And that's where the factors are involved. So what we're looking at is we're saying, well, take your example of Nvidia or Meta or Apple or any of the big ones. And you go, well, each and every one of those companies on that list has pricing, fundamental characteristics, size characteristics, and so forth. And we collect all this information. We buy it in from providers, but we collect it all. And we're able to compare companies based upon those characteristics, whether it's size characteristics, whether it's value characteristics, whether it's recent trading patterns, or whatever it happens to be. There's a huge range of characteristics. And we are able to combine them all into what we essentially is a multi-factor score. And that multi-factor score that we put together is used to determine whether we increase if it's a high score, or decrease if it's a low score, the weight of a company within the portfolio. And indeed, there are some instances where we have these two funds, and one fund is a much, much deeper value strategy than the other. The less concentrated, less focused value strategy, which is really just a sort of core strategy, that one, it's more of a gentle tilt towards smaller companies, or a gentle tilt towards more value oriented companies. Whereas the deep value, the focused value strategy, that is a much more concentrated, value approach, and it will exclude completely companies that have strong growth characteristics, whereas the other fund doesn't. That's how we end up with deciding how we weight the portfolio based upon the factors. Now we then have the ESG integrated, the environmental, social, and governance issues integrated in there. And what we do there is, well, essentially it just becomes another way of changing the score, the weighting score for a company. So if you've got a very high value company, which otherwise you might be very interested in having a high weight in your portfolio, but it's a massive polluter, it may get completely excluded if it really has very high greenhouse gas emissions. We may just say it's excluded completely, and that happens with a number of companies. There are other issues there. So the United Nations Global Compact requirements, which are very well documented. It's all about basically things like human rights and so forth, and the way companies should behave. If a company is non-compliant with any of the UNGC requirements, then we will exclude it. So there are some instances where companies get completely excluded as a result of the environmental, social, and governance issues. But on the whole, it's just more of a case of saying, well, this company has better, imagine that you've got two companies with the same factor characteristics and everything else, all other things being equal, you now had differences in ESG characteristics. The one with better ESG characteristics would attract a higher weight in the portfolio than the one with poorer ESG characteristics. And it's always a trade-off, and there are lots of moving parts. And really, that's what our skill is being able to judge these trade-offs in a very systematic way to end up with a portfolio where your expected returns from your factors are not diluted by the incorporation of the environmental, social, and governance issues.
So it kind of makes sense to me. You always have to start with a starting point, don't you? I mean, even if you're
absolutely,
in inverted commas, an active fund manager, you still got to start from somewhere. But what you're doing is you've got a system that effectively scores and then reduces it down, and then that's where you end up with your portfolio. Obviously, when you're picking a stock, so if you're purely active and you're going, oh, right, this stock here is good value, however they do it, and that's going to do really well. You always get that perception that requires a lot of work. But even listening to the way that you do it, it feels that technology has to be involved in it. And the reason behind this is one of the questions that I was going to ask you is around the size of your team. Because if you look at the likes of Fidelity, any of those companies, they're huge companies. Yes. And yet you've got this relatively small team, and yet you manage a lot of assets compared to a lot of people. And so it'd be really interesting to see how you are able to achieve what you achieve with what you've got. And then I guess a concern that some investors may have, and I don't think this is a fair comparison, but I guess it's one that someone might sort of throw up, is that, you've had smaller teams, the likes of Woodford as an example. And, I don't think the two kind of even come close together, but that may be in some people's minds is, look, you've got this small team. How does it work? How are we protected, and how can you achieve what you achieve?
Yeah. Well, I think your first comment about technology is absolutely on the money, so to speak, because you couldn't do this without computers and the ability for individuals to process enormous amounts of data, because there's a huge amount of information and data out there. And we are true believers at GSI. We're absolutely true dedicated believers in focusing on what you do well and outsourcing the rest. So the GSI team may be small, but we're focused on what we do best, which is really focusing in on the investment side, and then the sort of talking about that to our clients. But we're also supported by much larger organizations. I'll give you a couple of examples. So the funds that we manage, they are run on Gemini runs the platform that those funds exist on, the UCITS platform in Dublin. And Gemini has the responsibility for all the architecture of those funds, for the legal side, the compliance side, the oversight. And it's interesting you mention those issues where other managers have had problems. We have a lot of external oversight. In other words, companies that are nothing to do with us, external oversight on us. And Gemini is one of those companies. So they keep a very close eye on what's in the portfolio. Every now and again we get requests for information about, what's this company doing there? What's that company? Tell us about, why you've been buying this, why you've been doing this. And so it keeps us honest in a very rigorous way. And so that's Gemini has that responsibility for the UCITS side. And then we have another company, Cosegic. They're our compliance consultancy, and they provide a breadth and depth of expertise that we could never match. And so we do that with all these things that aren't core to our business, and people find that perfectly natural for companies to outsource their to an external accountant. They find it perfectly normal for people to have external HR people searching, but we just do it with as much as we possibly can if it's not core to what we do. And as a result, we're able to keep the core GSI team very small, but we have this support of much larger organizations that allow us to do the job very effectively and very efficiently.
And I guess it does reflect, doesn't it, that the market and the world is changing. I guess that's the thing, is that, that there's been that tendency to kind of hold everything as much together as you can. But if that's not your core competency, then outsourcing it or being in partnership with someone else to take that on is probably the best way of doing it, isn't it?
Well, it certainly works for us. I can't make that statement for any other company, but it certainly works for us.
Yeah. They've got a couple of questions around sustainability, ESG, and approach and engagement. And I think probably the first area, before we go a little bit deeper into it, is there's a lot of talk around the FCA, their sustainable labels. And I know that this has sparked debate. I appreciate that your strategies are Dublin based, so obviously they're not subject to those requirements. So I guess the two things that I'm thinking about within this, and again, it would be useful for people who are listening to this, is the first side is on the FCA side. It's kind of around your thoughts on their approach, perhaps its strengths and weaknesses. And then because yours is Dublin based, it then has the requirements of European rules, which are different. Yes. And whether that then creates this confusion. So there's a few different parts to that, but it'd be interesting to get your thoughts around all of that.
Yeah, well, regulations are important. You need to have rules. You need to have a level playing field. So the question is, what kind of regulations do you have and what do you need? And the purpose of regulations is, to my mind, twofold. The first and foremost is to protect the investor, which is, absolutely front and center of any regulator's minds. The second is to make sure you've got a functioning market. You need to have a market that functions properly. And sometimes new regulations can be confusing and difficult to implement. And I think these new ESG regulations and naming conventions specifically are case in point. The way that I see it is that where things have landed at the moment are that the regulators and the regulations have become somewhat prescriptive in the naming. And they've said, okay, because what they're aiming to do is to make sure that investors have a clarity about the investment that they're putting their money in. And there have been instances, I couldn't tell you how widespread they are, but there have been instances where companies have said that they've got very green credentials, they do all sorts of good stuff, whereas actually they haven't done that. And that's the greenwashing argument. And so the regulator has stepped in saying, well, okay, there's an enormous amount of interest in this from the investment public, the investing public. So we need to make sure that it's clear. So they've become very, very prescriptive about certain terms like sustainable or green, all these terms that might appear in the names of funds. And what's ended up happening is there's a bit of a round hole square peg problem. Because it's so prescriptive, if you happen to be a peg that's round, you're fine. But if you're a peg that's square, that's got corners, you're not so fine. You find yourself that you don't fit the regulator's definition of what it means to be sustainable, for example, even though you may have an enormous amount of stuff that goes into your portfolio that you consider to be a sustainable approach. My sense is that there are a lot of very valid approaches that don't satisfy the naming convention, because the naming convention tends to be a little bit hard and prescriptive, that will have to change their names, taking out any reference to ESG, sustainable, green, and so forth. And it's not clear to me that allows much clarity, much more clarity. It becomes very definitive for a small subset, but less so for a larger subset. And I think that is an issue. But with all new regulations, there is always a bit of a time for these things to work. Now, to your point about Dublin-based versus or European-based versus UK-based, it's not really adding, to my mind, more confusion for our clients, because we really have to operate under both regulatory environments. That is GSI, we are UK-based and we are regulated by the FCA. The funds may sit over in Dublin, but they are marketed to UK investors. And so what we are doing is really saying, okay, let's act as if they were governed by the same naming conventions.
I think you picked up on something that I'd like to kind of explore a little bit more, because I think there is a lot of confusion, or I feel there's a lot of confusion, is that you get terms like sustainability, ESG, impact, and they're often used interchangeable. So you get that element of confusion, which I'm sure that's why these labels have come in. I've mentioned to you before about the FTSE for Good index, where I've looked at some of the companies within there,
yes,
and I'm not 100% convinced that if I was looking for an index that was doing good, that some of the holdings within that fall into that. And so I guess the thing is that somebody might see your strategy, see sustainable, and they might have a thought as to what they're expecting to see within that.
Yes. Yeah.
So how does your strategy kind of navigate this kind of, I guess, this muddy water, even without these labels? If we just strip out the labeling, how do you kind of navigate that?
Well, it's all about communication, really, isn't it? It's about making sure that the investor understands the process, or at least if they don't necessarily need to understand it in absolute depth, right down to the weeds, so to speak. Really, it's about understanding the principles. So you throw out some of those labels there, and you've got sustainable, and you've got impact, and ESG, and so forth. And I think this is where it does get a little tricky, perhaps a little murky, because you do have funds out there who are aiming to change the world, so to speak. They are the impact funds. They're saying, okay, let's find companies that have the technology to change our world. And that might be to do with carbon capture. It may be to do with finding alternatives to plastics. It may, whatever it happens to be. Indeed, it could be something as simple as power generation through natural and renewable resources. And they focus on those investments. And in general, those sorts of funds fit neatly into the whole FCA descriptive process. And they're very clear about what they do for investors. But that's not what we do. What we're trying to do is say, look, you've got choices, or at least we're trying to give you choices. On the one hand, we're looking at the principal rationale for investing is to get a long-term return for the money that you're investing. You have to take some risk, and you want to get a return for that risk that you're taking. And so what we're saying is, look, we understand, we have a very good understanding of how markets work, and these are the factors that drive returns, and we will build portfolios using those factors. And back in 2017, 2018, we were talking about this with Max Tennant and his firm iFirmax. And he said, look, this is all well and good, but surely you must be able to do the same thing. But take into account the environmental issues associated with those companies that you're investing in. And we said, oh, that's a very fair point. Can we improve the profile, the environmental credentials, let's say, of the portfolio without compromising on the expected returns, on what it's there to do? And our view was that yes, we could. So we were able to introduce. What it's not doing is it's not trying to be an impact fund. We're not trying to change the world. We're just trying to find companies that have a better transition plan, for example, that are not huge polluters and don't have the highest greenhouse gas emissions, companies that do comply with the UNGC requirements, and so on and so forth. And that's why I called it earlier almost like a hygiene issue. It's what we're trying to do is an improved version without losing sight of the original purpose of the portfolio of the fund, which is the long-term returns for our investors.
Could you potentially then have an oil company within this if you felt it was going down the right route?
Absolutely.
Yeah,
absolutely. I mean, it's a discussion that we've had frequently, and there's a range, there's a spectrum of behaviors in, say, for example, the oil industry. Some companies are unquestionably better than others. And oil is almost an inevitable fact of our the way we currently live. It is the source of much more than just fuel for your car. Various plastics, various medicines, and even simple things like input to your washing up liquid. It is everywhere. But that's not to say that it should be. And yes, there are alternatives, and yes, we are very keen to explore those. But right now, it is a part of our everyday existence, and it does have a place in our portfolios. However, it's very much reduced in our exposure. So, for example, let's measure it in terms of greenhouse gas emissions, for want of a better number or metric. We aim for our portfolios, our funds, to have a greenhouse gas characteristic or emissions of half that or less than the just the plain vanilla index, the market cap weighted index. And by the way, that measure is already a harder bar to get under, because if you did that versus a pure value index, let's say, a pure value index would be absolutely chock-a-block full of the worst offending mining companies, oil companies, and so forth. So, by comparison to if we were doing nothing, the greenhouse gas emission characteristics of those funds would be off the charts. So it is a major reduction, but it still does mean that we do have exposure to oil companies, to energy companies, to mining companies, and but a much lower exposure than we otherwise would have.
And I guess that leads on to another question, is around, like, when people look at sustainable strategies exclusionary, there's this kind of argument, and I think we've kind of covered this, so I'm not going to labor the point, but they talk about active management is the only way that you can do it. But I think the question that I've got here is more about, how do you engage, or what is your feeling around engagement to drive change?
Yeah. Well, this is another case in point where we outsource, and partly it's to do with the voting strategy, partly it's to do with forming coalitions with other like-minded managers. So in the grand scheme of things, even though we manage what is a very large amount of money, we are tiny in the grand scheme of things. But every vote matters. And when we were talking to, we employ an external proxy voting firm called Minerva, and their specialty is environmental, social, and governance directives, so to speak. And Minerva have been very helpful in assisting us in our proxy voting policy and the approach that we take. And we talk to them about this engagement. Well, we talk to them about voting, and it's really all about saying, look, you have to understand that voting does matter, whether that's voting for in your local elections or whether that's voting on a proxy voting form. Because if you don't do it and everybody took that view, what's the point? So partly it's about voting, it's about participating and making sure that the companies in which you're voting know that you're voting in that particular way. And occasionally letters are sent to companies saying, this is how we plan to vote. And just by highlighting that, companies go, okay, this is an issue that we need to be aware of. Whether they then subsequently do something is another matter, but it raises it to their attention. And over time, you can build up a body of votes, not us personally, but there is a body of voting builds up, and you see a subject which started off where you had 95% voting for and 5% voting against, then the next year it might be 7% voting against, and the next year 10%, and so on and so forth. And it begins to get some momentum in terms of the publicity it garners, and also the attention it gets from senior management within that particular firm. So that's the voting side of things. Then you have these coalitions. So we participate in various different groups where there are topics of interest in companies. So it might be the oil industry, it might be banking, or it might be the chemicals industry. And then particular firms within those industries, whether it's BASF in the sort of chemical side of things, or whether it's HSBC in the banking industry, or whoever it happens to be. And there will be groups of investors coming together saying, okay, right, we all have a small amount of ownership, but add it all together, and it goes from being a small amount to an amount that, whilst it's not going to be a majority, it's still very small minority, actually is enough to garner the attention of the company and to get them to engage with us as a group. And by doing that, you magnify your own your own investment of the funds in conjunction with others, and therefore are able to leverage off these joint approaches.
And I think it's interesting you talk about that. And, obviously we talked about how you communicate the strategy and how, being quite honest about how you approach engagement. And as you say, it's that kind of, being able to make sure it's happening, but outsourcing it to someone who can spend time on that and do that. It's interesting, isn't it? Because I think that it goes back to this whole debate as to what do people want. And maybe a difficult question to answer, but who would you say for your strategy, who is your ideal audience, would you say? And do you feel there are limitations, or do you think that actually, I mean, I kind of personally, and I don't want to lead you on that, but I kind of think it gives people who might want to see that something positive is happening, but they don't want that real deep dive element to it. This kind of sits quite well, but it'd be quite interesting to see where you sort of see where it fits.
It's an interesting question. I'm not sure I know the answer to it, in all honesty, because I've been surprised at who has been interested versus who has lacked any interest in it. All I can speak to is the people who have engaged with us, and we don't typically engage or connect with the end client. Our business has been discussions with advisors mostly, or consultants to those advisors, and we've found that it tends to be the advisors who are, first of all, a little bit more scientifically aligned, if you will. There may be advisors who've had backgrounds in engineering or have come from that side of business. And they have appreciated this concept of investing, or taking a systematic approach to investing, scientific approach, whatever you want to call it. And then incorporating the whole ESG or environmental side of things in the same manner has also appealed or resonated with them. Now, whether that can translate to the end client, I genuinely couldn't tell you. But certainly I would imagine that advisors who find what we do interesting probably have a client base of a similar mindset. And to my mind, the ideal client, sorry, not client, end client, the ideal advisor would be someone who was curious, who was thoughtful about changes in the marketplace and what's new, what's interesting, but not flash in the pan stuff, but more, okay, what's new and interesting that really has some sort of proper rationale behind it, has some real thought behind, and something that is understandable. I think the one thing, and I can't say I can shine any more light on this, but I was talking to my eldest son, and he was asking me about crypto, and I said, honestly, I do not understand why crypto is as popular as it is, or why people would consider that to be an investment. It's clearly something that has advantages in anonymity for some groups, but beyond that, it's a mystery to me. And so, from my perspective, that's the sort of topic where, yes, it's new and it's interesting, but to me, it has no rationale and has, in my mind, and I will put myself out there saying I genuinely do not feel it has a place in anyone's investment portfolio.
Yeah, I like that. There's a quote, and I can never remember the exact words, but it's like, don't invest in something that you don't understand.
Yeah.
And I think you're absolutely right. And I guess the approach that you're taking is systematic. It's based on evidence, and
yes,
you're following that through. If there was kind of, I guess, a key insight or piece of advice or just a thought that you could leave with the people who are listening, what would that be?
My view is that from our perspective, and I think the point, that rather trite quotation, which I suspect was probably attributed to Warren Buffett at some point, whether he actually said it or not, is another matter, about never invest in something you don't understand. It might be Soros, it might be Buffett. It's been bandied around. But my other thing is that from our perspective, We are in the business of trust. You really do have to trust the people that you're doing business with. And transparency and openness is the key to that. And I think that if anybody feels that people they're investing with are not as transparent and open, then I would say that that's always a red flag. And tagged on to that, because it comes to in amongst all of that, you've got this environmental, social, and governance naming sort of murk that's out there. I would say don't give up on that environmental, social, and governance stuff. It is important. It will be very important going forward. It's more and more mainstream. And I think a lot of managers, ourselves included, are working very hard to make sure that it stays mainstream.
Thank you. And I like the way you said, because one of the arguments that I've been talking to, or arguments or ones of discussions, is how do you articulate value? And I think a lot of value comes from that trust that you build up. And, we try and quantify value by a monetary amount, but actually, it sounds so simple, doesn't it? It's like, if you can get trust, then, that's a massive thing, isn't it? So
yeah, it is. It's priceless.
Yeah. So look, thank you so much. I've taken so much of your time. And for me, it's been fascinating. I think, talking about the kind of active index, talking about ESG, talking about your approach, ending with that kind of transparency, openness, trust, just, absolutely fascinating. Anyone who's listening today, more information on GSI, their website is gsillp.com. So please go onto that and have a look. And also to our listeners, thank you for tuning in today. If you've enjoyed this episode, make sure you subscribe for more insights. We'll be back soon with another episode. Thank you very much. Thank you.
Brilliant. Thank you, George.